It seems like everywhere you turn these days, everyone's talking about DeFi,
Yeah.
decentralized finance.
It's really,
It's hard to ignore all the hype.
yeah, it's gotten so much attention, especially with, all the market swings and the volatility we've seen.
Right, and it can be tempting to just focus on the price action and all the speculation.
For sure, but I
Yeah,
think
sure.
what's really fascinating is the underlying technology that's making all of this possible.
Yeah, what's going on beneath
Yeah,
the surface?
exactly. And I think that's where things get really interesting because, we're talking about financial services that are being completely reinvented,
Right.
like lending, borrowing, trading, all these things that we're used to doing through banks.
Yeah, the traditional institutions.
Exactly. But now they're happening without them.
It's all happening on blockchains powered by code.
Right. And that code is what we're going to dive into today.
Yeah, that's what we're here for.
Smart contracts.
Our deep dive into DeFi and the smart contracts at its core.
So we've pulled together some great sources to help us understand this.
Yeah, we got a good mix.
We start with Wikipedia,
Mm,
which gives us a really solid foundation on DeFi in general.
the basics.
And then we've got this really detailed working paper from the European Securities and Markets Authority, or ESMA.
Okay, ESMA.
And they've actually done some fascinating work categorizing different types of smart contracts.
So this will give us a framework to think about them.
Exactly. And then we'll get into some more practical stuff.
Yeah, some real-world examples.
Looking at Binance Academy and Gemini, which have some really clear explanations of things like impermanent loss
Oh, yeah, that's a big one.
and yield farming, which is another, popular concept in DeFi.
And we also found this interesting Reddit discussion that had some great insights.
Real people sharing their experiences with providing liquidity to these DeFi protocols.
So it's not just theory.
Right. We'll see how this all plays out in practice.
We'll get the good, the bad, and the ugly.
Exactly. So our goal today is to use these sources to really understand the nuts and bolts of DeFi
What makes it tick?
and to explore some of the potential pitfalls as well.
The risks involved, because it's definitely not all sunshine and roses.
Not at all.
So let's unpack this, starting with those smart contracts at the heart of it all.
All right, let's get into it.
What exactly makes them so crucial?
Well, as Wikipedia explains, DeFi is built on these things called permissionless blockchains.
Oh, missionless.
And smart contracts are essentially self-executing agreements that live on these blockchains.
Self-executing agreements, that's a mouthful.
It is, but it's a really powerful concept.
So what does that actually mean in practice?
It means that the terms of an agreement can be programmed directly into code.
Okay, so instead of having a lawyer write up a contract,
Right. You write it in code.
and then the blockchain automatically enforces those terms,
Exactly, without the need for any intermediary.
like a bank or a lawyer.
Precisely. So think about a traditional loan, for example.
You go to the bank, fill out a bunch of paperwork.
Lots of paperwork, and they decide whether or not to give you the loan.
Right, they're the middleman.
But in DeFi, the terms of the loan are written into a smart contract.
And the blockchain just takes care of everything.
Exactly. It ensures that the loan is executed as agreed upon by both parties.
Wow, that's pretty amazing when you think about it.
It's really revolutionizing how we think about finance.
So Bitcoin introduced the world to blockchain back in 2009,
Yeah, the first blockchain,
but it wasn't until Ethereum came along around 2017
as Wikipedia points out.
that we really started to see the potential of smart contracts for all sorts of applications.
Right, Ethereum really opened up the floodgates.
And DeFi is one of the biggest areas where it's taken off.
Definitely. And since then, we've seen a ton of other blockchains emerge that also support smart contracts.
They've all jumped on the bandwagon.
Yeah, it's become kind of the standard.
So it's not just a random jumble of code.
No, not at all.
There's actually a structured way to think about how DeFi is organized.
Absolutely. Wikipedia outlines this really helpful layered architecture.
Okay, layers like a cake.
Kind of. So at the bottom, you have the settlement layer.
The base, the foundation,
Yeah, and that's the blockchain itself.
the underlying technology that everything else is built on.
Exactly. Then you have the asset layer.
The building blocks.
Right, and that's where the digital assets live.
Cryptocurrencies.
All sorts of tokens, yeah.
And then above that, we have,
The protocol layer.
this is where the smart contracts come in.
Exactly. This is where the magic happens.
The rules of the game.
Right. These smart contracts define how everything works.
For lending, for borrowing, for trading.
All the different financial activities.
Okay, and then at the very top, we have
Like application layer.
what the users actually see.
Right. The decentralized applications, or dApps.
The interface.
Exactly. And Wikipedia also mentions this additional layer.
Another layer.
The aggregator layer.
What's that all about?
So this is basically a service that helps users find the best deals across different DeFi platforms.
Like a comparison website for DeFi.
Exactly. It aggregates information from various decentralized exchanges and protocols.
So you can find the best rates for lending or borrowing.
Or the most liquid trading pairs.
So it helps users navigate the DeFi landscape.
Exactly, because it can get pretty complex.
So we've got these layers, but how does this all compare to traditional finance?
That's a great question, and the ESMA paper really dives into that.
They highlight some key differences.
Yeah, the biggest one is how finance is structured.
Okay, how so?
Well, traditional finance, you have these very distinct entities.
Like banks exchanges.
Exactly. And each of them plays a specific role.
They're the gatekeepers.
Right. And you also have separate financial instruments.
Stocks, bonds.
Mortgages, all sorts of things.
So everything is very compartmentalized.
Very siloed. But in DeFi, it's all much more integrated.
Everything's intertwined.
Exactly, as ESMA points out, the smart contracts and the protocols themselves take on the roles of those traditional intermediaries.
They're the new gatekeepers.
Right, but they're not centralized institutions.
They're just code.
Code that's executed automatically on the blockchain.
So the code itself enforces the rules.
That's the beauty of it.
Yeah.
And the financial instruments.
What about them?
They become tokens or digital assets that are traded directly between users.
On decentralized exchanges.
DXs,
Okay, so it's much more peer-to-peer.
cutting out the middleman.
And in theory, more transparent.
Definitely, because everything is recorded on the blockchain.
Yet this whole DeFi thing hasn't just appeared overnight.
No, it's been a gradual evolution.
Wikipedia points to some pretty significant growth in recent years.
Yeah, we saw this huge surge in 2021.
The total value locked in DeFi reached a peak of $178 billion in November of that year.
That's a lot of money.
It shows the massive amount of interest and investment that was flowing into DeFi.
And Wikipedia also mentions that it's subsequently dropped.
So things have cooled down a bit.
Well, the market has been volatile in general.
Crypto winter and all that.
Exactly. But what's interesting is that even with the price fluctuations, the level of developer activity and innovation in DeFi remains really high.
People are still...
Oh yeah, there's a lot of excitement and new ideas popping up all the time.
And it's not just individual developers tinkering around.
No, Wikipedia also mentions the increasing involvement of venture capital in DeFi projects.
So big money is betting on DeFi's future.
It seems so, and that suggests that there's a lot of belief in its potential.
Yeah, and Wikipedia even brings in the economist's perspective on all of this.
Oh, what do they have to say?
They frame digital finance as this interesting three-way fight
A three-way fight.
between established big tech companies,
Okay, the Googles and Facebooks of the world.
right, and then
Sure.
big countries exploring central bank digital currencies.
CBDCs.
Exactly. And on the other side, you have the decentralized efforts of DeFi developers.
So it's like a battle for the future of finance.
That's how the economist sees it.
Interesting, and the ESMA paper gives us another way to look at this growth.
By looking at the actual deployment of smart contracts over time.
Exactly. They've tracked this data, and they've identified two major periods of increased activity.
Okay, two waves of development.
Right, one around 2017, 2018.
Which coincides with the rise of Ethereum and the early days of DeFi.
Exactly. And then a much more significant one between 2021 and 2023.
The DeFi boom.
Right. And what's interesting is that ESMA observed that these surges in development activity coincided with increases in the price of Ethereum.
So when the market is hot,
There's more incentive to build.
makes sense. More people are paying attention and there's more money flowing into the space.
Exactly. And the ESMA paper also highlights that the types of smart contracts being deployed change between these two periods.
Okay, so the DeFi landscape itself was evolving.
Exactly. Their analysis suggests that the first wave of development was largely driven by initial coin offerings, or ICOs.
Remember those?
Yeah, they were all the rage back then.
A way for projects to raise funds.
And the dominant type of smart contract during that period was focused on raising and moving funds.
What ESMA categorizes as financial smart contracts.
Right, so it was all about the money.
But then things started to shift.
But the second wave of development,
What did ESMA see happening?
they saw a much wider range of activity.
Not just ICOs anymore.
No, they noted a significant increase in token-related smart contracts.
Which makes sense given the explosion of different types of digital assets.
Right. We saw the emergence of things like stablecoins.
Pegged to the value of a fiat currency.
And then the rise of non-fungible tokens, or NFTs.
Unique digital assets like digital art and collectibles.
And this led to the need for more sophisticated smart contracts to manage all of these different tokens.
And there was also a push towards standardization.
Yeah, things like ERC-20 for fungible tokens.
Interchangeable tokens like most cryptocurrency.
And ERC-721 for non-fungible tokens.
The unique ones.
And the ESMA also observed growth in what they call operational and infrastructure smart contracts.
What do those do?
These are the contracts that handle the behind-the-scenes stuff.
The plumbing.
Exactly, things like managing how different protocols interact with each other.
Ensuring that everything runs smoothly.
Right, so this indicates that the DeFi ecosystem was maturing.
Moving beyond just basic financial transactions.
It was becoming more complex and sophisticated.
And this brings us to one of the most important parts of the DeFi ecosystem.
Decentralized exchanges.
DXs.
Yeah, these have become a cornerstone of DeFi.
And they're pretty much what they sound like.
Cryptocurrency exchanges that operate without a central authority.
No middleman.
Exactly. Users can trade directly with each other.
Or through these automated systems called automated market makers.
AMMs.
It's all explained really well in Wikipedia, Binance Academy, and Gemini.
Yeah, they all agree that DXs are a fundamental part of the DeFi landscape.
So how do these DXs actually work?
Well, Binance Academy explains that they use smart contracts to automate the entire trading process.
So instead of having a centralized order book,
Like traditional exchanges.
DXs use these smart contracts to match buy and sell orders.
Based on pre-programmed rules.
Or in the case of AMMs, based on algorithms.
That determine the price of the assets.
So it's all driven by code.
Exactly. And this has some pretty significant advantages.
Like,
well, Binance Academy highlights the key principle of decentralization.
which is at the heart of DeFi.
Right. No single entity controls the exchange,
It's all run by code on the blockchain.
which also generally leads to enhanced security.
Because users maintain custody of their own funds.
Exactly. Instead of depositing them on a central platform.
Or they could be vulnerable to hacks or theft.
Right. And there's also the transparency of transactions recorded on the blockchain
Everything's out in the open.
and the potential for greater efficiency and liquidity,
Especially through these things called liquidity pools.
which Gemini really emphasizes.
Okay, so what are liquidity pools?
Well, both Binance Academy and Gemini explain that they're basically smart contracts.
Here we go again with the smart contracts.
They're everywhere.
So these smart contracts hold pairs of different crypto assets.
Right. So you might have a pool with Ethereum and USDC, for example,
And users can swap between these assets directly within the pool.
without having to go through a traditional order book.
And the automated market maker part
The AM.
refers to the algorithms that govern these pools.
Exactly. Gemini explains that these algorithms automatically adjust the price ratio of the two assets.
Based on the trading activity.
So if more people are buying Ethereum, the price of Ethereum relative to USDC will go up.
And vice versa.
Right. The algorithm constantly rebalances the pool to maintain a certain ratio.
So it's all designed to keep the trading smooth and efficient.
That's the goal. But where do the assets in these liquidity pools come from in the first place?
That's a good question.
Well, that's where liquidity providers or LPs come in.
Okay, LPs.
And both Binance Academy and Gemini explain that these are users who deposit their own tokens into the pools.
So they're the ones providing the liquidity.
Exactly. They're the ones making it possible for others to trade.
And they get rewarded for doing so.
They earn a portion of the trading fees generated by the pool.
Sounds like a pretty good deal.
It can be, but there are also risks involved.
Which we hinted at earlier.
Right. And the Reddit discussion we looked at, along with information from our other sources.
Makes it clear that there are definitely some things to be aware of.
Yeah, there's no such thing as a free lunch.
So let's talk about some of the risks, starting with the basics.
All right, what does Wikipedia have to say?
Well, right off the bat, they mention coding errors in the smart contracts themselves.
That's always a concern with software.
And because everything in DeFi is governed by code,
Any flaw can be exploited,
leading to hacks or loss of funds.
which unfortunately we've seen happen.
Yeah, there have been some pretty high-profile DeFi hacks.
And Binance Academy and Gemini both reinforce this point.
They emphasize that the security of the smart contracts is crucial.
Because as these contracts become more complex and interconnected,
The potential for hidden bugs or vulnerabilities increases.
it becomes harder to audit and ensure that they're completely secure,
And Wikipedia also brings up the issue of front-running attacks.
which are kind of unique to the transparent nature of public blockchains.
Explain that one.
So because pending transactions are visible on the blockchain,
Everyone can see what's coming.
Someone with technical skills could see a large trade about to happen.
Like someone buying a huge amount of a particular token.
Right, and they could then execute their own trade just before it.
To profit from the anticipated price movement.
Essentially, they're jumping in line ahead of the big trader.
And taking advantage of the price impact.
Exactly. And to try to mitigate this, some DeFi platforms offer what's called slippage tolerance.
Okay, slippage tolerance.
It's a way for users to set a limit on how much the price can move against them during a transaction.
So if the price slips too much,
The transaction will be canceled.
to protect the user from excessive losses.
But it's not a foolproof solution.
And Wikipedia also draws an interesting parallel between the current DeFi landscape and the ICO boom of 2017.
That was a wild time.
A lot of hype and a lot of scams.
And there's a concern that some of the same dynamics are at play in DeFi,
Because the complexity of these platforms can be overwhelming for newcomers.
especially those who are new to crypto in general.
And unlike traditional financial institutions,
There's often no customer support to turn to if things go wrong,
you're kind of on your own.
which makes inexperienced investors particularly vulnerable.
To scams or just making costly mistakes?
And Gemini also highlights a very real risk in DeFi.
Rug pulls.
Yeah, unfortunately, we've seen instances where DeFi projects gain traction,
They attract a lot of investment,
and then the creators just disappear with the funds.
leaving investors holding worthless tokens.
It's a classic bait and switch.
And it highlights the importance of due diligence.
Absolutely. You really need to research the projects you're investing in.
Don't just blindly follow the hype.
And then there's impermanent loss,
Another big one.
which both Binance Academy and Gemini explain in detail.
This is something that anyone considering becoming a liquidity provider needs to understand.
Definitely, because it can have a significant impact on your returns.
So what is impermanent loss in a nutshell?
It's the risk that the value of the tokens you've deposited in a liquidity pool can decrease compared to what they would be worth if you had just held on to them.
So you could actually lose money even if the price of the tokens goes up.
This sounds counterintuitive.
It is, but the key is that the ratio of the two assets in the pool is constantly changing.
Based on trading activity.
As that ratio shifts,
The amount of each token you hold in the pool changes as well.
and if the price of one token goes up significantly relative to the other,
You could end up with less of that token than you originally deposited.
even though the overall value of your holdings might have increased,
The term impermanent is a bit misleading,
because it suggests that the loss is temporary.
but it's not realized until you withdraw your funds from the pool.
And it can definitely eat into your profits,
Binance Academy even provides some examples.
showing how different percentage price changes can lead to specific levels of impermanent loss.
So it's not just a theoretical risk, it's something that can actually happen.
And the Reddit discussion we looked at shows that some users have been caught off guard by this.
They didn't fully understand the risks.
And they ended up losing money.
It's a good reminder to always do your research.
And the ESMA paper also raises some important points about broader risks in DeFi.
Beyond just the individual protocols.
Right. They highlight how the composability of DeFi can actually create systemic risks.
Composability, what's that?
It's the fact that different DeFi protocols can easily interact with each other,
They can build on top of each other.
which is great for innovation.
It allows for the creation of all sorts of new and interesting financial products,
But it also means that there's a lot of interconnectedness.
which can increase the risk of contagion.
If one key protocol fails,
It could have cascading effects throughout the entire system.
like dominoes falling.
Exactly. And ESMA also mentions the potential for rehypothecation in DeFi.
Rehypothecation, that's another mouthful.
Yeah, it's basically where assets that are already being used as collateral in one DeFi activity,
Can be pledged as collateral in another,
which can amplify concentration risks.
because the same assets are being used multiple times.
And unlike traditional finance, there's often no centralized oversight to prevent this.
Which brings us to the big elephant in the room.
Regulation.
The ESMA paper really emphasizes the difficulties in regulating DeFi.
Yeah, the challenge.
Because of its decentralized and borderless nature,
There's no central authority to go after,
and the principle of code is law.
which is often cited in the crypto community. Poses some interesting legal questions,
And the pseudonymity of many developers.
makes it even harder to hold people accountable.
So regulators are grappling with how to approach DeFi,
They want to protect consumers and ensure financial stability.
but they also don't want to stifle innovation.
It's a delicate balancing act.
And it's not all just about creating these innovative financial products.
The ESMA paper also points to the emergence of what they call illicit smart contracts.
the dark side of DeFi,
Things like Ponzi schemes and other
which
scams.
shows that this technology can be used for nefarious purposes as well.
It's a reminder that DeFi is not a utopia.
There are bad actors out there, just like in any other industry.
So it's important to be aware of the risks.
And to do your research before investing in any DeFi project.
Absolutely. And that brings us back to the ESMA working paper's efforts to categorize smart contracts.
They're trying to bring some order to this chaotic landscape.
Exactly. They use a technique called topic modeling.
To analyze a large number of smart contracts on the Ethereum blockchain, looking for patterns and similarities in the code.
And through this analysis, they were able to identify 5 major categories
5 main types of smart contracts.
that are prevalent in the DeFi ecosystem.
Okay, let's break those down.
Starting with the first category.
Financial smart contracts.
As the name suggests, these are the contracts that handle the core financial functions.
Like lending and borrowing.
Exactly. And platforms for ICOs.
Raising funds for new projects.
And decentralized autonomous organizations, or DAOs.
Which are basically organizations that are run by code instead of people.
Right. And they also include things like mechanisms for airdropping tokens.
Giving away free tokens.
And insurance protocols.
DeFi insurance.
And then, of course, the smart contracts that underpin AMMs and DX pools.
The heart of decentralized trading.
And interestingly, ESMA also includes less savory applications in this category.
Like Ponzi schemes and lotteries.
Because they also involve pooling and distributing funds.
So it's a broad category.
Encompassing all sorts of financial activities.
And the second category?
Operational smart contracts.
These are the behind-the-scenes contracts.
The unsung heroes of DeFi.
ESMA describes them as contracts that facilitate the functioning of other smart contracts.
They're like the tools and utilities that keep the system running smoothly.
Okay, give me an example.
Well, they might host libraries of code that other smart contracts can call upon.
So instead of every contract having to include all the code it needs,
It could just reference these shared libraries.
which makes the code more efficient and manageable.
Exactly. And they also play a role in optimizing how resources are used.
And in handling errors.
Making sure that if something goes wrong,
Yeah.
it doesn't bring down the whole system.
So they're essential for the stability and scalability of DeFi.
Absolutely.
All right, and the third category.
Token smart contracts.
These are all about managing digital tokens.
Creating them, issuing them, tracking them.
And ESMA specifically connects this to the ERC standards on Ethereum.
The most widely used token standards.
So ERC-20 for fungible tokens.
The interchangeable ones like Bitcoin or Ether.
And ERC-721 for non-fungible tokens.
And NFTs.
Unique ones.
So these token smart contracts define the rules and functionalities for all these different digital assets.
Okay, and the fourth category.
Wallet smart contracts.
These are focused on the user experience.
Exactly. They handle how users interact with the blockchain and manage their accounts.
So things like managing transaction fees,
Keeping track of balances.
controlling access to funds.
Yeah, and setting permissions.
So they're like the interface between users and the blockchain.
Exactly. They try to simplify the user experience.
And make it easier for people to manage their digital assets.
And then finally, we have the fifth category.
Infrastructure smart contracts.
These are the low-level contracts that handle the nitty-gritty details.
The plumbing of the system.
Exactly. They deal with manipulating and processing data.
Things like working with strings of text,
Boolean values,
digital signature,
encoding and decoding information,
managing memory usage.
and handling transaction payloads.
These are the essential building blocks that allow different parts of the DeFi ecosystem to communicate and work together.
They're crucial for interoperability and scalability.
Making sure that everything runs smoothly and efficiently.
And what's really interesting is that by tracking the prevalence of these different categories of smart contracts over time,
We can see how the DeFi space is evolving.
the ESMA paper does this by analyzing the deployment rates between 2017 and 2023.
And what did they find?
They found that the initial focus was heavily on financial contracts,
Likely driven by the ICO boom.
but the subsequent period saw significant growth in token operational and infrastructure contracts.
Reflecting the broader development and diversification of the DeFi ecosystem.
It's like looking at the blueprints of a city to see how it's grown and changed over time.
So DeFi is not just about the money anymore.
It's about building out a more comprehensive and robust decentralized financial system.
With all the tools and infrastructure necessary to support a wide range of financial activities.
And that brings us to our concluding thoughts.
What have we learned today?
Well, we've explored how DeFi presents this really novel approach to financial services.
built from the ground up on smart contracts,
And it offers some potential advantages
like decentralization and increased accessibility,
through platforms like DXs.
and opportunities to earn through yield farming,
But we've also highlighted the considerable risks,
security vulnerabilities in the code,
the potential for financial losses like impermanent loss,
and the overall complexity of navigating this rapidly evolving landscape,
which is often unregulated.
and the work being done by organizations like ESMA
To categorize and understand these smart contracts,
is a crucial step towards gaining better insights into DeFi.
which is essential for addressing concerns around investor protection and financial stability.
So here's a question for you to consider.
What do you think?
Given the immense innovative potential of DeFi,
Alongside its very real risks,
how do you envision it shaping the future of finance?
it's a question worth pondering
And what role do you believe regulations should play?
in guiding its development.
We encourage you to delve deeper into the concepts we've discussed today,
And really consider the implications,
both for your own financial future.
and for the wider world.
Thanks for joining us on this deep dive into DeFi and smart contracts.
It's been a pleasure.